The number of sample sizes of past monetary tightening cycles is nothing. It's not statistically significant. You have to think about the context in which it's happening and the context in which like Amazon, Nvidia, Google, Meta, Apple like dominate the economy. Like those companies don't care that interest rates are higher. They have huge cash balances that they're earning actually net interest income on. So it's just a different story. If you're thinking about whether we're going into a recession or not, like the labor market looking pretty healthy and the US economy being less interest rate sensitive are two huge things which people are missing.
This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gen Drop campaign and be part of the future of regulated digital assets today. Welcome back to another episode of On the Margin, and joining me today is Eric Wallerstein, Chief Market Strategist at Yardney Research. Eric, it's great to have you. I think you have the best charts on Twitter these days, so I'm really excited to nerd out on some with you.
Thanks, Felix. Yeah, no, it's a pleasure.
Before we get into it, though, would love to just hear a little bit about your background, because I feel like you've had some pretty unique perspectives on things and how that's really driven how you look at the macro from a broad basis.
Yeah, so I've been at Yardney working with Ed for a few months now, maybe 4 or 5 months. Before that, I was at the Wall Street Journal, covering really everything from like options and volatility to asset allocation, as well as fiscal and monetary policy. Which, you know, it's a very interesting time to cover the Fed and the Treasury. That experience was great. I mean, you get to talk to a lot of very interesting investors and get a lot of very varying perspectives. Working with Ed's been great to just focus on the macro more so and what it means for broad asset allocation trends. And then before the Journal, I was at the New York Fed. So I was on the repo desk when for those who remember the September 2019 kind of repo market freak out, as well as COVID. So trading in the repo and reverse repo operations, working on the Fed facilities and speaking with banks about like, what does this mean for you? What does this mean for your balance sheet? Monitoring market conditions, essentially. So that's all been very helpful. And I think especially as we get towards, quantitative tightening or QT starting to wind down, should be even more interesting. But, it gets pretty in the weeds. And some people on Twitter seem to appreciate it, but like by and large for investors, it can kind of be like noise in your head a little bit.
Yeah, totally. I feel like that's always what's so hard is, you start to go down the rabbit hole of macro and it just feels like you get stuck in analysis paralysis.
Yeah,
it can be tough for sure. But yeah, for those that are listening, this is going to be a pretty chart heavy video. So, if you're listening on audio, definitely recommend switching over so you can look at some of these charts. Because like I said, I think Eric has some of the best charts in macro right now. So we're going to let those, lead a lot of the conversation here. So let's get into it. You have been talking a lot about the labor market and some of the, pretty idiosyncratic things that are going on in it during this cycle. So here you just have this chart looking at the composition of unemployment by reason. And, just want to open it up to you to see what you're seeing here and what are some of those insights that you can derive from it.
Yeah. So, I mean, and excuse some of my puppy is a little whiny this morning. But yeah, I mean, broadly, we're pretty optimistic. Ed's been bullish since mid to late 2022. There's been a lot of like hard landing recession calls. Some people kind of gave up on those as the economy and markets did pretty good, but plenty of people are still saying like the labor market is deteriorating rapidly. The SOM rule was triggered. The Fed has to ease drastically right now. There were calls even for emergency 75 basis point cuts a couple weeks ago. So yeah, I think like thinking about the labor market and it's, yo, come on, buddy. I'll bring him on camera in a second just to pacify him.
Perfect.
But yeah, I think when you break down the underlying rise in unemployment, listen, we went from 3.5% to 4.3% in about a year's time. Is 4.3 high? Like, no, it's definitely not. But that's a rapid change, and you don't want to see that steep acceleration like we've seen in past cycles. So in this chart, we just break down unemployment by like why someone says they're unemployed. And you can see in July when we went up to 4.3%, that temporary layoff number kind of spikes. Come here, buddy. Okay. He was going to help me real quick.
That is a cute dog.
Yeah. He's been outside like 5 times this morning, but still it's not enough.
That's good.
So that temporary layoff spike, we think, is part of the reason that unemployment is actually going to go down to 4.2% this month, which we'll see on Friday or last month. But look at permanent layoffs. I mean, this blue line has been so muted and is actually now the lowest since September 2023. Less than a quarter of people who are unemployed have been saying it's because they were permanently laid off. And then look at reentrance, this red line. The labor force is growing rapidly. We're seeing the highest labor force participation among prime age, both men and women. We're seeing a ton of immigration. I think the CBO had like 6.6 million just over the course of a couple years. So the implications of this are unemployment rises, right? You have a lot of people coming into the workforce. On one hand, it's immigration, but we're also seeing people just encouraged by real wage gains, which have been going on for the past year plus. So like when I see record prime age employment and record prime age labor force participation, I don't think the labor market's like falling apart at the seams. You know what I mean? We're just cooling towards what we had pre-pandemic. And I think that's the thing people are missing.
Yeah. So if we were going to see like a more traditional recession, you'd see this blue line like pretty much surge higher, right?
Yeah, definitely. And I mean, you can see in the beginning of this chart, like coming out of COVID, it was substantially higher. 35% of unemployment was due to a permanent layoff. And we had reentrance, that red line, like well lower. You know what I mean? It wasn't because we had a growing labor force. It was because people were getting fired. And now we have people coming into the labor force. Most people are getting hired. Again, it's cooling a little bit, right? Like hires are going down, vacancies are going down. Like, did you want an ultra hot labor market for 5 years after the pandemic? No, then we'd be dealing with, inflation is still a worry. And, we have PCE at 3.5% and the Fed has to hold or even hike. And that's not what you want to see. We want to see a soft landing. So it's just consistent with a normalizing labor market.
Yeah, makes sense. And on the next chart here, you look at jobs availability, right? Is that more looking into the supply dynamics of what's available, or what do you see there?
There's a big thing made about the consumer confidence survey that came out last week, basically showing jobs plentiful and versus jobs hard to get. It's kind of like the labor market differential have been narrowing, right? Like people saying jobs are plentiful has been falling from its peak. People saying jobs are hard to get has been rising. Okay, therefore the labor market is collapsing. I think this chart is a great way to look at it. It's the rate of change of the like jobs available series. So it's like jobs are not so plentiful. It's that middle ground. And it's been slowly rising. It's above 50%. But look at the way in which it's rising. That it's like a decelerating trend. So it's just like we're kind of getting back to normal where the labor supply and demand is in better balance versus look at every past recession. That number just shot up rapidly. People saying jobs are not very plentiful. So I think it's just another way to show like we're getting a normalization. I'm going to say it like 100 times, but it bears repeating.
Yeah. So I mean, what we're seeing here in these charts is it looks like it's a labor market that is still pretty good. Obviously, it's like you say, it's normalized. But when you go and listen to what Chair Jerome Powell was talking about, especially like at the Jackson Hole speech last week, you would think that the story would be very different. So what are they looking at that's so different from what we're seeing here? Because it feels like, you basically struck the Fed put anchored to the labor market, but it seems like the labor market's doing okay. So where is this hang up happening?
Yeah, what's interesting is Powell kind of sounded like this all the way up until Jackson Hole. And then he became ultra dovish, saying we're going to do whatever. It had like some Mario Draghi-esque language in there, like we're not going to let the unemployment rate, rapidly rise. And I mean, like it sounds a little politicized or whatever, but I really think Powell was speaking his own book, right? Like he wants another term. He's up for renomination with whoever wins the presidency. So he did the same thing last time he was up for renomination. He basically was ultra dovish because he was going up against Lael Brainerd for the Fed chair. And he let CPI get all the way above 6%, near 7%, before even considering tapering off the pace of, this should actually say QE taper, but spelling errors. before even stopping like buying as many mortgages as they were, as many treasury bonds as they were. And then he finally got renominated, and then they started, tightening balance sheet policy. And it took him a whole nother like half a year to start even raising interest rates. The whole average inflation targeting thing, I guess, makes sense when you go from 1.5% CPI for an extended period to 2.5%. But like, what were they doing when inflation was 7%? It's literally asinine. And I think that's what we're doing today. It's that he was like, all right, 80% chance or 60% chance, the labor market's fine. It's just normalizing. Unemployment will rise to 4.3, 4.4% and kind of level off. But he's like, I'm not risking that tail risk scenario where the Somme rule is right and the labor market's going to rapidly deteriorate. He just cut off that tail and he said, nope, I'm going to solve it. Because at the end of the day, he'll win renomination in a year's time or a year and a half. The effects of lingering inflation and perhaps sticky inflation or more upside risk for inflation surprises aren't going to hit him. So I think what it means is by and large, long-term inflation is probably going to be more volatile or higher than pre-pandemic. But for now, there's so much weighing on inflation that like they probably have room to be a little more sanguine.
And it feels like a lot of the underlying conversation here is, this discussion about, are we about to go into a recession or not, or whether we see this growth. Basically, we've seen this slow growth scare, and now we're going to reaccelerate higher. What are you seeing in terms of the savings rates? I know you have on the next chart there, and some of these more granular data points. And what is that telling you about where you lie in terms of recession or not?
No, I mean, like, plenty of people have been saying that the recession is nigh because the consumers tapped out or they've exhausted their savings from the pandemic, as if like a few stimulus checks was all that was driving the economy. I don't think that's the case. Like, real consumer spending is holding up. It's predominantly on services at this point because we like blew out all that good spending during the pandemic. But like, what this chart shows you is that the net worth that you have, this is just housing, but the net worth from stocks, from bonds, from housing, not to mention the income you're getting from higher interest rates like money market funds, encourages you to either consume or to save. So what you see is your inverted kind of real estate wealth relative to your income. So as that rises, you save less. So the personal savings rate fell to 2.9% last month. The same people who have been saying that's an issue for the last 2 years said it's an issue again. But no, rising asset values make you not need to save your income. And think about all the baby boomers who retired. Baby boomers own half the $150 trillion in wealth in this country. They don't have income. You know what I mean? They retired. All those retirements during the pandemic. So they are dissaving. So that's partly why that this like personal savings rate can be lower in this cycle for longer and it not be a real issue because you have a ton of wealth and interest income to draw on. So you don't really need to save. So I don't know. It's, people think the consumer is going to be tapped out. Like, I don't know, more power to them. I'm not sure what they've been doing. Like if you're short stocks for the last 2 years, if you're long TLT, you're kind of screwed in terms of P&L. But like, you'll be right one day, perhaps.
Yeah, when I see people talk about the personal savings rate, a lot of the time it seems like it gets compared to what sort of household debt or like credit card debt that they're racking up. And my issue with that is oftentimes that's being shown in like a nominal basis. And in this highly inflationary regime we're in now, it's super important to look at debt in real terms, understand that serviceability. So is that what you're looking at as well, to understand like yes, even though the savings rate is coming down, their ability to service, credit card debt and sort of like those things is still manageable.
Yeah, I mean, like I think household debt service payments to income is below 10%. It's like the lowest it's ever been outside COVID. So yeah, credit card balances are rising. Some people are going delinquent because like the rate on credit card has jumped like twofold. So naturally, if you were going to go delinquent before, it's happening much quicker this time around. But I'm not really seeing like major signs of stress. Like Dollar General had horrible earnings. Walmart and Target did fantastic. So, and it goes to this chart. So this is real average hourly earnings, inflation adjusting wage gains. So low wage workers is basically production and non-supervisory workers. They're 80% of the workforce. They've been beating inflation for the past year and a half, roughly. Like it makes up for a lot of post GFC real wage losses. So even though inflation was low, the lower wage workers were struggling to see real wage gains. That's been reversing, so getting us back to the long-term trend. It's actually the high wage workers who were losing out relative to inflation. Granted, like the inflation in terms of things that are like basic survival needs, the base of like Maslow's hierarchy is much higher than some discretionary things. So lower income households were getting hit, and also higher wage workers had like wealth, like real estate wealth and a lot of stocks to draw from. So like it's less of an issue for them. But no, I mean, low wage workers have been doing well. I understand like sentiment sucks because housing affordability sucks and survey response rates suck. Like inflation took prices from where they were to 33% higher in a matter of a few years. That sucks. Like, why would sentiment be good? I think it's the proof's in the pudding of the spending data, of the wage data. People are doing good, all things considered. So if there's a recession, like there's a recession, but no one's seeing it or feeling it.
It feels like we're not used to living in this more inflationary economy because we'll see, consumer confidence come down. They attribute it to potential recessionary fears, but it feels like it's actually more just a cost of living issue due to inflation, which is the opposite issue in a way.
Yeah, no, I mean 100%. If you look at the Michigan consumer confidence survey or whatever it is, super negative, like everyone, but it's also a survey that mostly measures inflation. If you look at the consumer confidence survey, much happier, above 100, like people are feeling better. It's also a survey mostly asking, do you have a job and do you feel comfortable with the jobs market? So I don't think we were going to have this massive inflationary episode and a global pandemic and people are going to be happy-go-lucky. You know what I mean? People feel inflation. It hits them in a variety of ways. But by and large, like the economy is doing well. And I think that's a story that we've been trying to tell. This is a big reason why inflation has been pretty tame. This is non-farm productivity in the US and then the EU, basically the monetary union. The big spike, as like a disclaimer, the big spike in European productivity and the big fallout is because Europe has super stringent labor laws. You can't fire workers. So when your output deteriorates, you still have the same amount of workers and your productivity declines. So then when they reopened, productivity spiked. The real trend is that the US productivity is substantially higher than EU productivity. So that means real wage gains. It means better profit margins. It's one reason the S&P is doing so well. Profit margins have been rising. And it means lower unit labor costs. Mm-hmm. Unit labor costs, whether you believe this or not, Powell certainly does. They're the underpinning of inflationary trends. They're like, what is inflation in this country? It's unit labor costs. Productivity is the denominator. So higher productivity means less inflation, like accounting definitions. And we've had real productivity gains. And the whole BLS revisions to payrolls, I think, are kind of BS for a variety of reasons. I don't think they include enough of the immigrant labor. But if that was true and GDP is still high, then this number would be substantially higher.
So I just want to break down a couple of things that you said there. So first, I just want to understand a bit better what drives productivity, because you could either just see I think individual efficiency go higher, per employee. There's a lot of different ways it could happen, and I know it's also related to the actual labor productivity print is somewhat related to the BLS numbers, which have been going through these revisions. So just paint a bit of context there on how all of those points are interrelated.
Yeah, no, I mean it's fuzzy, right? Like how do you measure someone's productivity? Overall, what you're seeing is output per hours worked. Essentially, our thesis for the rest of the decade is that robotics, automation, artificial intelligence, just tech in general should fuel higher productivity. You're already seeing it in earnings calls. Walmart, Amazon saying how many hours worked, how it's just falling off rapidly for how much they're getting out with AI. I think X tech, let's just think about productivity long term, right? Tight labor markets force companies to invest in productivity enhancing technology or whatever that boosts productivity, right? Yeah, I think as we've moved towards a more high tech services oriented economy, like China and EM ex China, emerging markets excluding China, are doing more of the manufacturing, right? Like emerging markets are by far powering the world in terms of goods producing. The Europe sucks, right? Like Germany's industrial production is nothing. It's they're really struggling to compete with China, who's dumping goods. So yeah, you have these productivity gains. Why does the EU have no productivity? They have super tight labor laws, so labor can't shift to where it's most needed, like it can in the US. They tax rather than create. Like, when's the last time Europe had a big like innovative tech company? They just like tax US domiciled companies. So no, I mean we think this number continues to go higher. I also think on the margins, this wave of immigrant labor, like they'll become more productive as they spend more time in the labor force. So that's another productivity enhancer. But let's look at a couple of the structural reasons for this. So this is breaking down GDP, looking at it becomes like too many words to be honest, but it's basically non-government investment that isn't housing. So non-resi fixed investment, intellectual property skyrocketing. Like this is a much bigger contributor to GDP than structures or even equipment. And equipment includes info processing equipment, includes data centers. So like you're getting a boost from data centers in here, and IP is still a much bigger contributor. What does that mean? We're going to get more productivity. And two, it means we're less interest rate sensitive. Like software and R&D are the big contributors to intellectual property. Software is mostly SaaS, right? Like software as a service, you rent it. R&D is not very capital intensive, like building a factory or building a factory basically. In structures, you had a little bit of upward lift because the government subsidized a bunch of FOBs, the chips facilities, right? Like, would a big chips facility be built in a higher rate environment? Probably not, but like we have government funding. So this tells two really big stories, and this is looking at R&D and software under IP, and then info processing equipment. It's literally going gangbusters, right? Like this is exponential growth. And yeah, the economy is just different. And that's why ISM manufacturing, which we had this morning, which has been below 50 for 2 years, it just doesn't matter. Like it's 8% of employment. We aren't a manufacturing economy. We provide services. We invest in high tech. And that's the story. Like that's what the US is now.
Yeah, it feels like, to your point, I was looking at those ISMs that came in this morning, and it really tied into this theme that you also mentioned about, how we have this new economy where indeed it's hard for, rates to fully affect it. And paired that with what we've been seeing in inflation over the last couple of years and CPI is that, we've been seeing like goods deflation on a month over month basis at the same time that it feels like services are elevated. So do you see that as one of the main drivers, is that we just have stagnant like goods manufacturing while the economy transforms into this new age?
Yeah, so I mean, it's actually one of the reasons that inflation's been so subdued as well. And like, everyone says it would have taken a recession to get inflation down. We have a recession in China. They're exporting. Import prices from China are negative year over year, and so is Chinese PPI, and therefore, like goods CPI in the States is either negative in terms of durables, or it's like flat for non-durables. Like what a recession in China is pretty like meaningful for the global economy. So does like the US manufacturing like need to pick up dramatically for the overall economy? No. Do both political parties seem to be focused on it? Yes. It's kind of like a campaign rhetoric thing. Like maybe they'll do things to revitalize the factories. I don't know. I don't really care from a GDP perspective. It just doesn't matter. But until China like figures it out, which I don't think they do anytime soon. They seem kind of screwed. Their domestic demand is just so weak, and it's not like a really flexible economy in terms of boosting consumption with where they're at with over indebtedness. Like, I don't think goods prices have much room to rise.
So I just want to pause for a second, just sum up the story and narrative that we've talked about so far. So effectively, we have a labor market that is probably better than what it looks like on the top line numbers. That 4.3 unemployment print last month was due to some more of these idiosyncratic factors, as opposed to some sort of like substantial business cycle change. We're seeing significant increases in productivity and efficiency, and just a change in composition of what drives GDP to what feels like these forms that are a lot more scalable in terms of like economies of scale versus like this like full on, capex build that you see in more traditional, archaic versions of GDP. So all of that, what does that tell you in terms of like this big picture of, I know on the next slide you have something on nominal GDP. What is that story telling you about just looking at it from the top line like that?
Yeah, here I actually want to bring it to, because we all invest and everyone cares about that. So this is PE ratios for the S&P, X mega cap 8, which is just the Mag 7 plus Netflix because we like movies, and the rest of it. So like economies of scale that you mentioned, like these companies can just grow so dramatically quicker and their profit margins are so much wider. It kind of just commands a higher valuation than we're comfortable with or used to from the past. Am I going to tell you that Nvidia trades at a fair valuation, or like the Mag 7 aren't pretty expensive? Like, no, they're pretty expensive. But that's not to say they're too expensive. You know what I mean? Like the way this economy operates and the way tech companies can grow so quickly and scale up, it just kind of defies what we're used to. And that's why looking at like the N, right, the number of sample sizes of past monetary tightening cycles is nothing. It's not statistically significant. You have to think about the context in which it's happening and the context in which like Amazon, Nvidia, Google, Meta, Apple like dominate the economy. Like those companies don't care that interest rates are higher. They have huge cash balances that they're earning actually net interest income on. So it's just a different story, and we can kind of cruise through some of these too. But yeah, no, I think like if you're thinking about whether we're going into a recession or not, like the labor market looking pretty healthy and the US economy being less interest rate sensitive are two huge things which people are missing.
This episode is sponsored by Mantra. The Mantra chain, built with the Cosmos SDK, is the blockchain of choice for regulated digital assets, offering compliance-ready modules and cross-chain interoperability. With partnerships like a $500 million tokenization project with the MAG Group in collaboration with Zanbank in the United Arab Emirates, Mantra is at the forefront of the RWA revolution. Scalable with up to 10,000 transactions per second and secured by a sovereign proof-of-stake validator set, Mantra is designed for both permissionless and regulated applications, making it easier for institutions to enter Web3. Discover more about Mantra's capabilities and how you can participate at mantrachain.io. All right, back to the show. Just on that next slide there, I want to dig in a little bit on consumption here. And we had that revised print that came out last week that surprised some people to see an upward revision in consumption. So it feels like, the consumer is strong. I want to ask you, what would change your mind? What would change the story and narrative for you to be more concerned about a recession? Would it just be that, the consumer falling apart like that, which is obviously we've seen the opposite, but what would it be?
Yeah, I mean, I think if the labor market did substantially deteriorate, that's a huge issue. Our two biggest risks right now are, one, there's a geopolitical crisis that like raises the cost of oil and therefore food and therefore everything else. Or there's like a blow off top. It gets too ebullient. The current rally, probably rate cuts are what fuels it because they unlock housing and autos. But the current rally just gets too hot and then it falls apart. In terms of the consumer, like as long as they have a job and feel comfortable about getting a job and their wages are beating inflation, I don't think they're going to stop consuming, man. It's what the US consumer does best. We're mostly buying services. And so the bottom two bars on this are blue is services consumption, which is now 45% of overall GDP. And then the red is goods, which is less than 22%. You can buy services all the time. Like if an economy is centered around durable goods, like how many washer machines are you going to buy? Like how many cars are you going to buy? How many concert tickets are you going to buy? Like a lot. You can buy infinite concert tickets. You can go to one a week. You know what I mean? It just like it perpetuates a cycle of consumption. And listen, if the stock market goes into a bear market or real estate prices fall off because of the surge in supply that happens when mortgage rates fall, I don't think they will fall off dramatically. But if they do, then maybe we get a retrenchment and the consumer retrenches, and like all those companies that borrowed at SOFR plus 700 during the pandemic, go bust because private credit couldn't figure it out. And then we have some layoffs. Then you have to like, how strong is the Fed put? I think it cleans it up and we're still okay. But that's a reasonable scenario. Like it could happen. It's the end of 2024 and it hasn't. Yeah, I don't know. There's definitely things to consider, right? Like not everything is so rosy. It's just rosier than everyone expected.
Mm-hmm. Yeah, that's well said. And I think that leads into quite a nuance. Do you have that? You expect Powell to cut rates in September, but I know
Yeah.
your perspective is that he doesn't need to, or he necessarily shouldn't. The next few slides, I know you have one on looking at just fiscal deficits and also looking at how Fed funds affects the economy. Would love to just open it up to let those charts speak to that perspective and why you don't necessarily believe that he needs to be cutting rates right now.
Yeah, I mean, it definitely will. So, like, don't position for otherwise. Though I think like the path to a 3% Fed funds rate over the next year or year and a half is too optimistic. I don't think that'll happen. I think growth will be too strong for that to happen. We also have I think the election's a big question mark. You get a sweep by either party, you're probably going to get more fiscal deficits and more inflation. But this is the real Fed funds rate versus real GDP. I actually don't love scatter charts because I think like you have to contextualize based on a time series to get everything else that's going on. But like, is a 2.1% real Fed funds rate going to throw the economy into a recession? Clearly not. Like this shows an upward sloping relationship. 2.1% looks pretty normal and it looks consistent with pretty solid real GDP. So yeah, no, it looks like we just got back to normal after being in ZERP forever and letting zombie companies just exist, right? Like,
yeah, to take the devil's advocate of what people might say to that is they would look at something like, debt to GDP ratios and say, well, okay, back in the day, back in the 70s, we could handle much higher real GDP without sacrificing, real Fed funds rate without sacrificing real GDP. But
yeah.
now we have much higher debt to GDP ratios. So maybe we cannot handle that high of a real Fed funds. What do you say to that?
Yeah, I mean, like, I think, debt to GDP is a thing. The US is obviously very unique. We're like supplying the world with reserve assets when we issue treasuries. And you can see from like our current account deficit or whatever, like, what else is the world going to buy? Like, are they going to buy German debt? Like, there's not enough boons out there. The ECB owns nearly 90% of them, and Germany is committed to austerity at all costs. It's kind of not working out well for them, but like, I don't work for Germany's political machine. So yeah, I think we're okay. Like the fiscal deficit's an issue. This chart is my favorite. The fiscal path is really bad chart. Basically, it shows what has the deficit been as a percent of GDP. And curiously, it's always been below the unemployment rate, or at least not during a recession. And current forecasts have the deficit being higher than the unemployment rate for the next decade and forever. We're running recession or war-like fiscal policy during an economic expansion. What does that mean? It probably means interest rates should be higher. It's a higher neutral rate. But like we're stuck with like ZERP brain, we think anything over 1% is going to ruin the economy. The outlook of this, if rates are too low and the deficit's too high, inflation should go up. That's why I think like long-term inflation will be higher than we're used to. But for now, like inflation's going to 2%. You know what I mean? Like we're coming off a huge surge and China is in a recession and shelter costs are coming down. The inflation measurement's coming down. So yeah, I don't know. Like why should rates be lower in a world where the fiscal deficit's permanently higher? They shouldn't.
Would love to just dig into the next two charts here and also just frame the conversation of those around what we've been seeing in credit markets, which is that credit spreads are incredibly tight. Like, even when we saw that deleveraging event from the end carry trade, credit spreads were pretty well managed. So there's not a lot of stress there. So what are you seeing in that world of credit?
First on this chart, so like, corporations haven't really like been bearing the burden of higher rates, right? They all turned out their debt during the pandemic. Plenty of them have cash on hand. So their net interest paid relative to profits is like the lowest it's been since the 60s. It's one reason monetary policy hasn't hit. I think credit spreads. So on one hand, like the credit universe is a bit smaller, like high yield is just smaller because so many corporate balance sheets are healthier. You had rising stars and the same number of high yield managers had to buy a slimming number of bonds. So like you just get downward pressure on spreads. It's kind of mechanical. But yeah, I mean, like they'd still blow out if there was signs of stress, like CCCs. are pretty blown out. Like those companies are screwed. But private credit helps. You know what I mean? You don't have to go to the leverage loan universe and like get a syndicated, troop of banks to give you financing. You can get Ares to give it to you with really bespoke terms and do payment in kind and just kind of let you float along until rates eventually come down. But no, I think this is a fantastic, the whole like long and variable lags argument. Like what, can I curse on this?
Yeah.
What the fuck is a long and variable lag? Like it's just like the Fed used to tighten and then a recession would happen. In our opinion, the Fed tightens, a financial crisis happens from higher interest rates, and then a recession, and then a credit crunch comes. The credit crunch doesn't materialize out of nothing. We had a mini banking crisis in 2023. Maybe that was it, but the Fed eased, the Treasury eased, they guaranteed the deposits at those banks, basically helped save the VC and crypto industry by ensuring Circle's deposits were okay. And look at Sluice. This is what banks are telling you. They're telling you that they're not tightening lending standards anymore. They've been lending the whole time. Like loan growth has continued. This is not what it looks like when long and variable lags are causing a credit crunch. Also, the Sluice is never like real. Like the banks who respond to these surveys are telling the New York Fed what they're doing. Like my desk used to run the senior financial officer survey, and they'd always say like, we told you this in the survey, but actually this is what we're thinking. So like, this is not, like, I don't know, sure, the long and variable lags are coming. Meanwhile, banks aren't tightening. They're not raising loan spreads. They're not tightening their standards. So I don't know.
It sounds quite similar to what happens where, banks don't want to go to the discount window because they don't want it to seem bad. So the same way they're just like, well, I don't want to say that, what I'm seeing is bad because I don't want to have like a something hanging over me like that.
Yeah. No, I mean, the survey responses just by and large are kind of garbage. But I think like this is consistent with loan growth, which is picking up. Banks are lending more and banks have more regulatory constraints these days. Like private credit fills a lot of that gap. So like it's part of the reason Sluice wasn't like this whole tightening procedure in 2023, which was exacerbated by the SVB crisis and stuff. Didn't like lead into anything crazy. But yeah, no, clearly people can deal with higher rates, I think is what this chart tells you.
Something I want to ask you that's sort of off the cuff, but somewhat related is, I don't see a lot of people talk about what the Fed did in 2020 when they started to actually buy credit. Like they were buying HYG and high yield credit like that. As somebody who's actually worked at the New York Fed trading desk, do you think that puts some sort of underlying, I don't know, put in credit that makes for secularly tighter credit spreads that make it be less of a signal? It's something I've been thinking a bit about, but I'm curious your thoughts as somebody that's actually like been at the New York Fed.
Yeah, no, I don't think it raises the strike of the Fed put, but it definitely like adds to its explosiveness. They had the primary credit facility, they had the secondary credit facility, like they're buying bonds from Apple at auction and in the secondary market. Like what that means for liquidity at a time when liquidity dries up is insane. There is some legal things that Senator Toomey did to prevent this from happening. Again, there has to basically be like a new and novel reason to restart them. But like, there's always a new and novel reason, right? Like it is unbelievable they started buying corporate debt.
It's shocking. And it arguably goes against the Federal Reserve Act, right?
Yeah, no, I mean, it's wigglish. It's an old act.
Yeah,
but
totally.
we were all pretty shocked. We're like, what are we doing? You know what I mean? One of my bosses was managing those facilities who he had experience from the great financial crisis and buying ABS and stuff like that. But no, it's whack. And that can certainly happen again. I think the BTFP in March 2023 is just like another example of how they can play this extreme game of whack-a-mole. And they're incredibly creative in terms of easing. They're pretty bad at tightening, but they're really good at easing. Like these are some pretty creative technocrats we got. Yeah, it's very easy to see that if conditions did become stressed, that is at least like a psychological thing that would keep spreads somewhat compressed. And it could be a real thing that keeps spreads compressed if the Fed just reenacts those facilities. They already know how to do it. You know what I mean?
Cool. Well, I want to shift gears into a bit more of, we've talked about the economic story, but let's talk about the market story, especially around what you're seeing in bond markets and just fixed income in general. And what are some of the insights you're seeing there?
Yeah, so I think we can start here. Inflation expectations in the market. So the first one, the blue line's break evens. And then the second one is like, It's what the Fed really likes. I used to have to pull it up every single day in the morning meeting. It's the five-year forward inflation expectations via swaps. They're both pretty like sanguine, right? Like inflation is going back to 2.5%. It's definitely higher than usual. I think the bond market's like, all right, we're going to have some inflation, or the chances that it goes higher are now higher. It's more probabilistic, but like markets are kind of sanguine. I'm less so, or I think that these could easily be higher in the next year or two.
I was just going to say, just to paint a bit of context on those two charts you had there, is it looked like what the first one was real rates derived from tips, and then the other one, for those that aren't as in the weeds on forwards, basically that's like a market implied real time inflation rate, correct?
Yeah. So the first one is just the blue one's nominal treasuries minus tips to get a sense of like what break even inflation looks like. And then the red line is like what are investors paying to hedge inflation risk. It's for the period 5 to 10 years in the future. So that's like long term, you know what I mean? As far as a Fed governor is concerned. But yeah, it's a good proxy. I mean, it's wrong all the time. You can make a lot of money. Like it didn't go anywhere near the 9% we saw in CPI, but that's because over the long run, the market expected inflation to come down. But yeah, I think the upshot for like investors is this is one of my favorite charts, and I had it as a cover of a journal story. It's the relationship between bond volatility, this red line, the move index, and your portfolio returns, like a 60-40, how a 60-40 portfolio would do. And bond volatility is associated with bad returns. Like times when bond volatility is high is when the Fed is changing interest rates drastically. It's when inflation is higher, and then you get bad returns. So like if you think bond vol is going to be higher and rates volatility is going to be higher, it's not great from an asset allocation perspective, at least in traditional assets. And I think this is a really simple picture to show you why. It's the correlation between stocks and bonds. I think we're all taught that like bonds are a hedge in our portfolios for stocks, right? Like whether it's 40%, 20%, 10%, like most of our 401ks, you probably have some bonds in there. And that's because historically we're like, all right, they're going to hedge. Stocks fall in a recession, everyone rushes into bonds, the Fed cuts rates. They kind of protect me from obscene losses and like help my long-term gains. The issue is when stocks and bonds move in tandem. When rates go down or yields go down, bonds go up, and also stocks go up. It's tends to be during high inflation or high inflation volatility environments. So we've had a positive correlation for the last few years. I think that's here to stay. You'll get days when like good news is good news or good news is bad news, and these kind of flip flop. But it's like over the long term. This is a 1 year rolling correlation. Like, what does it mean? So like this is imagine in 3 years from now, right? Like the fiscal deficit is a really big issue. The government's overspending, growth's a little weaker. Every time there's a bond scare, like in August of last year in September, and the Treasury like the 10-year Treasury freaks out, goes to 5% rapidly, stocks go down. So stocks are going down and bond prices are going down. Like you have to hedge that in a different way. Like your portfolio is now at a different kind of risk than it used to be. Do I think stocks are going down in the next year? No. Do I think bond prices are going up? Like, I don't know. I think 4.25, 4.5 is more realistic on the 10-year, which is a good amount of income. It definitely like shields you from some losses, like we saw during ZERP. We went from 0% to 5% on the 10-year, or whatever it was, 1%. Like you get hit, TLT got like creamed. That probably doesn't happen, but like it just in this kind of higher nominal growth world, you got to think about asset allocation differently. I think it's something a lot of investors are missing. It's not a 6-month trade. It's like a long-term, how do I protect my capital trade? And I think this correlation remains pretty high for a long time.
Yeah, and that just has such huge market impact because, like you say, the modern portfolio is 60% stocks, 40% bonds. And it feels like right now everybody's hoping to go back to that world of negative correlation again. But I think to your point, we might get small cyclical moves, but overall, like secularly, the correlations are going more positive. What does that lead you to think in terms of, again, longer term impacts? Are you looking at like the modern portfolio being something that broadens the diversification to, including things like gold and commodities? Or what's your perspective there for trying to find ways to better hedge this new world?
Yeah, no, I think I had the cover of the weekend Wall Street Journal, and it was like I had this chart and it said 60-40 is dead or something. I don't think it's dead. But it's important, especially if you have a target dated fund in your retirement allocation, like it's just going to buy more bonds as you get older. One of the things that we're worried about is a geopolitical crisis. We've been overweight gold, overweight energy or overweight oil, whatever you want to do as a way to play that and kind of hedge upside inflation risk. But no, I mean, I think like I'm not like a crazy in on like private markets. I think like their smoothing of volatility is a little like suspect. But no, I think it's very important. Like I know you're into crypto. Like I think a lot of investors would probably think about Bitcoin in this perspective. Like, like the correlation between Bitcoin and the NASDAQ was very tightly correlated. It's come off. Certainly Bitcoin's been trading a little more on its own, which I think is a positive for anyone thinking about asset allocation. Because before, like your overall portfolio was just more correlated. So that's probably a positive in terms of, if you're an allocator. But I think you have to think about like, what do I want to own in a world where stocks and bonds move in the same direction? Do I want to own less bonds? Maybe not. Maybe you like 4.5%. You know what I mean? Maybe money market funds are a bigger part of your portfolio, but it just opens up the thoughts. I own like in my PA, like CTAs and stuff like that to try and hedge it out. But it's just a consideration.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Cafiero will also be there. Not only that, but we're also going to be doing a live recording of the weekly roundup on the Margin Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code, Margin10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. Maybe for the last part of the show here, I know you have a couple slides that just look at the more global story. And I also want to frame this around just some of these, rate differential and currency price movements that we've been seeing over the last couple of months. It feels like that's one of the big stories is, you have the US that's finally starting to lean dovish. The ECB has already been cutting. I'm here in Canada. The Bank of Canada has been cutting, but we're seeing the Bank of Japan actually hiking. And all of these dynamics seem to be creating this rate differential stress that is causing currency stress, that is causing market stress. So what are you seeing there from this global story?
Yeah, I mean, I'll talk first on the yen. That was the big news, the big event. While I'm sure like most MDs on trading desks were on vacation. But yeah, I mean, like you had a generational funding opportunity in the yen, right? Like the BOJ had negative rates and they're so skittish. They were so skittish. They kind of like what the Fed did. They wouldn't tighten policy despite the fact that inflation was coming back. Granted, Japan hasn't had inflation for decades. So like maybe they wanted a little bit. And it's been doing well for their markets. I think Japanese markets, other than the US, look amazing compared to other developed stocks, especially Europe. I don't really like Europe. But no, I mean, like you had non-farm payrolls missed extremely hard to the downside. We got a lot of dovish easing priced in for the US. The BOJ was already they were already signaling tightening. Japanese banks were down like in a bear market over the past like month. And so rapidly you had like an unwind of one of the longest, like most levered trades in the market. Of course, you're going to see some pain, right? Like it just happens. Like carry trades get pretty big when no one touches them. And then, more juice gets put in over the past couple of years. So like, it's probably fine now. You know what I mean? Like, honestly, if the Fed cut rates like in an emergency fashion or cut rates in July, it would have been way worse. Like the yen carry trade would have unwound substantially more. And then like Jeremy Siegel would have been on TV for 2 days in a row saying, we got to cut rates. Maybe they cut rates because they think this is a real financial crisis. And like, we're not on a good path of monetary policy. So like, I'm very glad they did not cut rates in July. Probably like a lot of quantitative investors and algos have like that shock built into their like VAR calculations or value at risk. So like, they're not going to be as levered. The carry trade probably still holds up. It's a cheap currency to fund in. Rates abroad are higher. I think it's fine. I do want to talk about China a little bit. Like
Totally.
this is showing M1, which is narrow money supply. We usually look at M2, but for China, M1 is a better. It's like the most liquid cash, so it's what investors would use to immediately invest. Like this is what they might take out of a deposit and go invest right away. It's falling off even more than M2, which is a really bad sign for China. This is what it looks like 6-month advanced relative to GDP. You measure this against Chinese PPI or US import prices. It's the same story. M1 tends to leave those metrics by about a year. There's no stimulus in China. Why not? Like they're over indebted. They invested in a bunch of crappy projects that have no rate of return. They were just throwing money, and that worked when Deng Xiaoping was there because the economy was like nothing. It was an agrarian economy that was, 100 years behind or whatever it was. They didn't have an industrial revolution yet, so that was fine back then. But now, like, there's limited places to put that cash. Consumers don't want to invest in real estate because it's completely crashed, so they're buying a bunch of gold. It's more of a personal saving decision. And there's no domestic demand. Like they're just exporting their way out of this, which has global ramifications. But China looks like garbage. Like not a good falling night.
Do you think this is what's causing such downside in commodities? Because, I look at oil today, it's down over 5%. But, speaking of everything we just talked about, it seems like the US economy is doing okay. So is this the canary in the coal mine where it's China that's really leading to these lower prices and things like oil? Or what do you think?
Yeah, I mean, I think like copper has been a good signal because it's more tied to Chinese demand. You'd think oil would have more of a geopolitical risk premium given everything going on in the world. But it really doesn't. You know what I mean? Like it helps that the US is now a net exporter of energy, but like I don't know. I think China matters more for Europe, where their manufacturing sector is getting absolutely obliterated. It's definitely deflationary or disinflationary for the world. I don't know what like is this going to knock on to U.S. growth? I don't think so. I think it's just a positive from an inflation perspective, but it certainly hurts the places where there's a lot of FDI from China. But yeah, I don't know. Just like people have been trying to invest in China for a long time. It's tough to invest in a semi-closed economy. It's definitely hard to invest in a semi-closed economy that's falling apart. So I don't know.
No,
it's not financial advice, but don't. And then last thing, I think this is a really interesting chart, which tells you why there's so much, or it's like a symptom or like a sign or whatever, of why there's so much demand for treasuries. It's because Europe doesn't issue any debt.
Mm-hmm.
Like they just don't. And the ECB buys whatever they issue. France was by far, other than one or two Southern European economies, like Portugal had a huge wave of tourism and stuff that really helped their economy. France has been the only major European economy growing out of the pandemic. They've been not the shining star because it's a pretty dull star, but they've been the outperformer. It's because they had a huge fiscal push. They run like the same deficit we run, and that's going away. Like the European Union's fiscal police are going to do extraordinary budget procedures on France, on a number of Southern European countries, and just rein that in. So like the fiscal impulse is going away from Europe at a time when their manufacturing sector is getting crushed by China. And clearly it has an impact on growth. It's one of the reasons the US grew so much out of the pandemic. But yeah, it's gone. So like that means less bonds for the rest of the world to invest in. They buy treasuries, which pushes down our rates even as we run a crazy deficit. And it means European growth kind of sucks for the foreseeable future. So like, I don't know, there's reasons to invest globally versus the US. Stock valuations are one of them. Like it's much cheaper to invest in Europe than it is here from a valuation perspective. But like, maybe they're cheap for a reason. Like
I was going to say, it might be cheap for a reason. Yeah.
Yeah.
Yeah, I don't know. Anytime I look at like the Europe debt situation, it just blows my mind that they decided on this like monetary union thing of having a common currency but different debt markets. Do you see that get this trend continuing to a point where that gets severely strained? And I know there's already been strains before, like the Greek debt crisis and that sort of thing. But I don't understand how this can continue. What do you think?
Yeah, I mean, I'm gonna do my best to not pontificate on like European politics, but I think like the political situation there is quite stressed. The far right and far left are winning both in the parliamentary elections on the European level and underneath the surface in Germany, France, Italy's already run by the quote unquote far right party. And these, just like in the US, almost in a horseshoe theory kind of way, like they want to spend and they want to limit immigration. Like both the far left and far right want to spend heavily domestically and provide bigger social nets. It's a European conservative thing, but that runs directly opposed to what the EU wants to do, which is like rein in the fiscal deficit and rein in debt. So like you probably get like if France said like what's like Macron's out or whatever and Marie Le Pen is in at some point in the next few years and France is like fuck this, we're leaving the EU. That's brutal. You know what I mean? Like Brexit's one thing, but like France or in Italy leaving would be a whole nother animal. And just whether it's a non-zero risk, whether it's 10%, 20%, or 30%, I don't know, but it's non-zero, and that's not a great situation from an investment perspective.
Awesome. Well, that was a really great journey through some nerding out of some macro charts there. If I could just get you to sum up your perspective on all of that in a couple sentences, how would you put it? The main takeaways.
Yeah, I mean, I think like be wary of what looks like deterioration. We're coming out of a pandemic. I think labor market in the U.S. looks pretty good. Economic growth looks pretty good. We're more productive today, and we should be more productive for the next few years. We look good relative to history. We look good relative to the rest of the world. But be like from an asset allocation perspective, you're an investor. Like think about what are the risks. Higher inflation is probably a risk from here on out, much more so than it was for the past 2 decades. Think about like how am I going to invest to protect my portfolio from those risks. And just be mindful. You just don't go on autopilot. I know investing in the S&P 500 is like we're bullish on the S&P. We have an 8,000 target by the end of the decade, but like think about okay, what could potentially harm me, and like hedge or allocate from there. But no, I think we're optimistic. No recession looming. No long and variable lags to worry about. And yeah. And yourdeniquicktakes.com. Every day we send retail investors a few charts and some commentary. It's pretty cool. It's definitely like not the same as our institutional product, but like it's great for the everyday investor to get like a good sense of how we're thinking about the economy and investing.
Nice. Yeah, well said, and highly recommend that. We'll put the link in the show notes here. And if people want to find out more of your fantastic charts, where else can they find you?
I mean, like Twitter, DM me on Twitter. I respond. Our website has all of our or most of our charts up there for free. They update every day. So yourdeni.com, just go to our charts. It's a great resource, honestly. And if you just like poke around there, I know when I joined, I just spent like days just going through all the stuff we have. It's a great resource. So yeah, I mean, it's free. Might as well take advantage of it.
Nice. Awesome. Well, thanks again for joining us today. That was a really great conversation. Thanks, Eric.
Thanks, Felix.